Hi, it's John Mousseau. I'm the President and CEO and Director of Fixed Income at Cumberland Advisors. It is after the close on Friday, May 8th, and this week in the bond markets, we saw something that looked a lot like we saw a few weeks ago, and that's where Treasury yields have moved up slightly. So you had a 10-year bond go from basically 0.65 to 0.70, and you had a 30-year bond go from about a 128 to a 138. That's really just reflecting the fact that there's a lot of issuance out there, and the Fed is buying a lot of it, but not all of it. And you're starting out from fairly low yields. So we're not surprised about that. What you saw on the tax-free side was actually a bump in scales, which meant yields came down. And they came down about 18 basis points on 10 and 30-year bonds. So between Treasury yields going up and municipal yields coming down, you saw roughly about a 0.2 to 0.23 basis point change in favor of munis getting tighter. It's a very good sign for the municipal bond market, which continues to repair from the sell-off that we saw in March. Two other very good, strong points that we think makes the muni market continue to be attractive. We know that Congress is now considering a bill to add up to $1 trillion to state and local governments. That is for basically unemployment, because we know that's running low. And we know there's a lot of unemployed out there. We saw the number today, 20.5 million people now on the unemployment lines. That is a lot. It's a little less than they expected. They were expecting something along the line of 22 million. It doesn't change the frightful story that we now have more unemployed people than percentage-wise than any time since the Great Depression. That is a stark number. We think that turns around as America goes back to work, but it is really a telling number on how serious the issue is. One other point in the bond markets. You saw a troubled issuer come to market this week. That's the Metropolitan Transportation Authority, the MTA in New York. If you had to find a credit which looks different through the prism of the virus, that is it, right? People are not riding the subways or the trains. They have not been for the last couple of months. They'll start to do it slowly. Certainly not produce enough debt service to make up for some of the problems that they're having. Yet they were able to come to market with $700 million worth of bonds, and then they upped it to over $1 billion, and then they brought out another $500 million in taxable bonds. And did it come at a concession to the market? Yes. It came as an A-rated bond at about 5.25%. That is high relative to the rest of the market. For a different A-rated issuer that did not have problems with the virus, they probably would have come to market with somewhere around, call it 3.25% to 3.5%. So the penalty paid by the MTA was probably on the order of magnitude of somewhere about 1.5% to 1.75% above the market that they probably would have paid prior to the pandemic. The fact is that the deal was well oversubscribed. A lot of people bought it. The deal traded very well in the secondary market afterwards. And so it tells us that well-known names will still get a decent reception. It's usually just a matter of price. And if you think about the fact that the capital markets are still accessible, that we know more federal help is on the way, and most importantly, we're starting to swing back to work, makes us pretty constructive on the muni market in general. Thanks a lot. Have a nice weekend, and you'll see my colleague Matt in a minute.
Hi, Matt McAleer, Director of Equity Strategies at Cumberland Advisors. May 8th, just after the close. In a week like this, you say to yourself, this is an easy game. Most sectors straight across the board were up. The NASDAQ, as represented by, say, the Qs, QQQ, up 4 or 5% on the year. S&P down 8.5%. If you went back to December 31st, you'd say, okay, markets had some rips, some pullbacks. S&P's off high single digits. NASDAQ continues to outperform from a relative strength standpoint. What's new? You wouldn't even be able to come up with what the market's been through. But what the market does try to do is make each and every investor feel foolish from time to time. So this is one of those markets this week where if you're holding cash, you feel foolish. And I've said before on our weeklies, your main enemy as a trader, as an investor, is looking you right in the mirror. As a portfolio manager, we always need to control our emotions. We need to control our risk reward. We need to control reasonable entries and exits. And from week to week, those things will change. But the important thing is, even if you're in a scenario where you're holding 15 or 20% cash, or take our US ETF portfolio. Wednesday, we sold into some of this rip, Russell 3000. Thursday and Friday, we look at ourselves like we must be crazy. Market just keeps ramping. Well, what we're comfortable with is this market will be open trading Monday, the following Monday, the Monday after that, 4 months down the road, 5 months down the road. Don't compartmentalize single trades. I talked about back in March, the biggest mistake an investor or trader or portfolio manager can do is lose perspective and confidence in what they're trying to accomplish with capital that they're managing. So have a plan. One thing we've spoken about is trying to divide your capital into buckets: short-term money, long-term money. They get treated differently. What you want to do in terms of a trade can be different: shorter term, intermediate, longer term. Really work out that plan. That's what we try to do on a daily, weekly, monthly, annual basis. So in terms of what we're liking in the market, obviously growth still King Kong, really outperforming value. Although it was nice to see banks and energy get a lift. You know, they're big components of the value piece. What else we liked? We liked the fact that international has made a couple higher lows in here. Asia trades pretty dry. Asia trades nicely. Europe's coming around a little bit. There are going to be rips and pullbacks for the next 30, 60, 90 days, 6 months. You can't go and look at some of the numbers that John Mousseau mentioned earlier in terms of unemployment and percentages and not think that this market will be unable to just digest that and go higher. But have a plan. If you're sitting on some cash in portfolios, we spoke about this back in March and April, have levels you want to commit there. Make sure they are securities in your longer term portfolio that you want to hold for a year, 2 years. Some great companies out there that'll make themselves available. Everybody have a great week. We'll see you next week.